All right, so you sent over this research paper about corporate governance, and I gotta say, it's pretty fascinating stuff.
Yeah, it's a good one.
It really makes you think about, how we measure things like board independence,
Right.
and if that even connects to how well a company actually performed.
Exactly, yeah.
It's by Dalton and Ogwenis.
Weenies, yeah. Like the beer.
Ogwenis like the beer. I was gonna say, how do you pronounce that? Okay, with Gwenny's. So those corporate governance reports that companies put out, like, ever wonder if they're really telling the whole story?
Oh, for sure.
This research kind of dives into that, and it might change how you view those reports.
It might change how you view a lot of things. The paper really gets at this idea of something called construct validity,
Okay,
which sounds kind of jargony, but it's really just making sure you're using the right tool to measure what you're actually trying to study.
gotcha.
So think of it like this. You wouldn't use a thermometer to measure distance, right?
Yeah, that makes sense.
You got to use the right tool for the job.
So what are some examples where they think we're using the wrong tools, so to speak, in corporate governance?
Well, one of the big ones is how we measure company performance.
Okay.
Traditionally, a lot of research uses things like ROA or return on assets
Right.
to see how well a company's doing. But the thing is, a company can have a fantastic ROA and still not really benefit you, the shareholder,
Yeah.
directly.
Right, because a high ROA doesn't automatically mean higher share prices or bigger dividends, right?
Exactly.
Okay.
So the article suggests that we should be looking at total shareholder return, or TSR, instead.
TSR, okay.
And TSR reflects the actual change in share value plus any dividends paid out. Basically, what's actually landing in your pocket as an investor.
Interesting. And you're saying companies already track this in their reports?
They do. Yeah, you'll often see TSR featured really prominently in those annual reports.
Huh.
But for some reason, academic research hasn't really caught on to using it as much.
That seems like a pretty big oversight.
The authors think so too. They find it pretty puzzling.
So we might be measuring the wrong thing. And this other, potentially more insightful metric is right there in front of us.
That's the argument, yeah.
What kind of insights are we missing out on by not using TSR?
Well, they argue that TSR could reveal a lot stronger links between certain corporate governance practices and how much value is actually being created for shareholders.
Okay.
For example, when they looked at the relationship between CEO duality and firm performance using TSR.
Hold on. For those who don't follow this stuff closely, remind us what CEO duality is again.
Oh, right. CEO duality is simply when the CEO of a company is also the chairperson of the board of directors.
Right. Right.
It's a situation that can raise some concerns about too much power being concentrated in one person.
Got it. So what did they find when they factored in TSR?
Well, past studies, using those traditional metrics like ROA, they found a pretty weak connection between CEO duality and company performance.
Okay.
But when they used TSR as the performance measure, that relationship became much more significant.
So shareholders might actually be voting with their feet, so to speak, when it comes to CEO duality.
That's what the data suggests, yeah. It seems like the concerns about CEO duality, they become a lot more apparent when we look at it through that lens of shareholder returns.
Interesting.
And that actually brings us to another really key aspect of the paper, which is how we think about board independence.
Okay.
So traditionally, board independence is measured by the percentage of outside directors, the ones who aren't employees of the company.
Mhm.
But this article suggests that's way too simplistic.
Okay.
Because, just because someone is technically an outsider doesn't mean they don't have other relationships that could influence their decisions.
So someone could be on the board, but they're also, say, representing a venture capital firm that has invested in the company.
Exactly.
Yep. Okay.
The article calls these related party directors. So think about, anyone who might have loyalties to other entities like those venture capitalists or even the government. Those allegiances could definitely sway their votes on important matters.
So their interests might not always be completely aligned with the company's shareholders, even if they're not technically an insider.
Right.
Interesting. What are some historical examples of these related party directors?
Well, the article mentions union representatives on company boards in the past.
Ah, right.
Obviously, their primary allegiance there was to the union, not necessarily to the company or its shareholders. It really challenges how we've always thought about what it means for a board to be independent.
Yeah, it's pretty eye-opening.
Like, it might even be a bigger issue than just looking at whether someone's technically an employee or not.
So are we saying we need to completely, rethink how we define board independence?
It's something to think about for sure. Like, if we're not even measuring it accurately,
Right.
how can we really understand how it impacts company performance? And more importantly, how can we make sure that boards are actually acting in the best interests of their shareholders?
That's a really good point. It's like we need a new lens to view this whole board independence thing.
We might, yeah.
Speaking of shareholders having a voice, I wanted to ask you about this trend of withhold the vote campaigns.
Oh, yeah.
This seems like a really direct way for shareholders to actually say, hey, we're not happy with this board member, or we don't like this company policy.
For sure. It's a powerful tool, and shareholders are definitely using it more and more to hold companies accountable.
Have you been following any of these campaigns?
Absolutely. Yeah, there have been some high-profile ones lately
Yeah.
where it's really changed who's on the board or even company policies.
Interesting.
It's a trend worth paying attention to, especially if you're investing.
Yeah, for sure.
The article even suggests using the percentage of votes withheld as another way to measure shareholder sentiment,
No. Okay.
which could be really helpful for understanding governance issues, kind of like direct feedback from the investors.
So instead of just looking at like who's on the board, we can see how the shareholders actually feel about them and the decisions they're making.
That's exactly.
I've never actually participated in one of these campaigns. Have you?
Yeah. Not personally, but I've been watching how they play out, like I said.
Okay, so we've got these like new ways of looking at company performance and board independence, potentially more accurate ways.
Right.
What happens when we actually like use them, apply these new lenses to the data?
Yeah.
Does it actually change anything?
It does. It really does. Pretty dramatically in some cases.
Oh, what?
Like, let's take the example of officer and director equity,
Yes.
which is basically how much stock they own in the company.
Right.
Traditional measures, using things like ROA, showed a pretty weak link between that and firm performance.
Okay.
But remember that TSR metric?
Right. Total shareholder return.
Exactly.
Measuring performance from the shareholder's point of view.
Right. So when they looked at the relationship between officer and director equity and TSR, the company's TSR over 10 years,
Oh.
they found a much stronger correlation.
So the amount of stock that officers and directors own, they could actually tell us something about how well the company's going to do long term.
At least from a shareholder's perspective, yeah.
That's pretty significant.
It is. It highlights how those traditional metrics might be missing some really important information
Yeah.
about the long-term impact of certain governance practices.
It's like we're getting a clearer picture now, or a more detailed one,
Yeah, more nuanced.
of how a company being governed is actually connected to how well it does for its shareholders.
Exactly.
And the article also talks about that new concept we discussed,
Right.
using related party directors as a more sophisticated measure of board independence.
Yeah, instead of just looking at insider versus outsider.
Right, so taking into account those potential conflicts of interest.
Right.
Does their analysis show anything interesting there?
Their findings were in line with other research, suggesting that simple insider-outsider distinction might not actually tell us that much about shareholder returns.
So a board with more or fewer independent directors, the way we've always defined it,
Right.
doesn't necessarily translate to better or worse results for shareholders?
That's what the data shows, yeah.
Hmm.
But they do emphasize that looking at related party directors could be a much better way to spot those potential conflicts of interest.
Makes sense because, like we were saying earlier, even an outside director might be looking out for someone else's interests more than the company's shareholders.
Exactly.
Did they find a strong connection between those related party directors and TSR?
Not in this particular data set, no.
Okay.
But they believe it's a measure that could be really valuable in future research.
It seems like we're only just starting to really understand how these complex relationships within a company actually work
Yeah.
and how they affect shareholder value.
And the article even hints at even more sophisticated approaches, like creating company profile.
Company profiles.
Yeah, based on a whole bunch of different governance variables.
How would that work?
So imagine being able to look at a company and see its governance structure based on things like CEO duality,
Okay.
related party directors, how shareholders vote, long-term TSR.
Like a really detailed picture.
Right, a much more complete picture of how a company is governed.
Could we predict future company performance with that?
That's a great question.
Or even see if a company might be more likely to, do something unethical?
That's a really interesting thought, and it's something the authors want to see more research on.
Oh.
They believe that combining all these different measures can really help us understand how corporate governance works, the good and the bad.
This has been a really insightful look at corporate governance research.
It has, yeah.
We've challenged some old ideas and explored some really interesting new ways of thinking about performance and board independence.
Definitely.
But what are the key takeaways for our listeners?
Good question.
Why should they care about all of this?
I think the main message is that measurement matters. Like, if we're using the wrong tools to measure these really complex things, we're probably missing important information and maybe even coming to the wrong conclusions.
It's like trying to use a bad map to get somewhere.
Exactly.
You might eventually get there, but it's going to be a lot harder.
Right. And this isn't just about academics. It has real-world implications for investors, regulators, anyone who wants to understand how companies are run.
So what should our listeners do with all this? What's the call to action?
First, I'd say start questioning the metrics.
Don't just take those corporate governance reports at face value.
Right. Dig a little deeper, ask questions, think critically about whether those measures actually line up with what's important to shareholders.
And if you are a shareholder, don't be afraid to speak up.
Exactly.
Look into things like withhold the vote campaigns to make your voice heard.
We need to move beyond those simple measures
Right.
and start looking at corporate governance in a more nuanced and critical way.
This has definitely given me a lot to think about.
Yeah.
But before we wrap things up, what's your final thought-provoking takeaway for everyone listening?
You know, what I found most fascinating is this idea of creating those company profiles that we talked about.
Right.
Being able to assess a company based on all sorts of factors.
CEO duality, related party directors, how shareholders vote, long-term TSR.
Exactly, like a snapshot of how a company is actually run.
Yeah.
And the question that sticks with me is, could we use this kind of profiling to predict not just financial performance,
Right.
but also whether a company might be more prone to doing the wrong thing?
That's a big question.
It is.
Could we use it to identify companies that are actually committed to being ethical and sustainable?
That's what I'm wondering.
It's like, could we actually give companies an ethical risk score based on how they're governed?
Right. That would be so useful, especially for investors who care about where their money's going.
Totally. Or even for regulators.
Oh, yeah.
To know which companies to keep a closer eye on.
For sure. Or even for us as consumers.
Yeah. Right. Like knowing which companies align with our values.
Exactly.
It really feels like this is connecting how a company is run, how it does financially, and the ethical choices it makes.
It all ties together, and this paper really opens up some interesting paths to explore.
It does. It's given me a lot to think about, that's for sure.
Me too.
So any final thoughts for our listeners before we wrap up?
I'd just say keep learning about this stuff, you know?
Yeah.
Read those corporate governance reports, but read them critically.
Don't just take everything at face value.
Right. Except
If you're a shareholder, look into getting involved, like with those withhold the vote campaigns.
there are organizations out there pushing for more transparency and accountability in the corporate world. Support them.
Because at the end of the day, this isn't just some theoretical thing.
No, not at all.
It's about the values we want to see in the companies we're invested in, work for, buy from.
Well said.
By understanding these issues, we can all play a part in making things better.
A more responsible and sustainable corporate landscape. That's the goal.
Well, thanks for joining us for this deep dive into corporate governance research.
Thanks for having me.
Keep learning, keep questioning, and keep diving deep. We'll see you next time.